Hello, everybody. Kirk Spano here with the CEO of Aemetis, a company that I've been very high on for a couple of years and watching it execute. Eric, how are you doing today?
Doing great, Kurt. It is a awesome time to be buying low valued shares when you know what the future looks like, and the future is actually in a matter of months, not years. So I enjoy times when things are on discount and on sale. I actually go shopping at that point in time. As Warren Buffett says, the stock market's the only store where people run out the doors as soon as the things go on sale. And
Right.
I think this is a great time to be an investor.
Right. I think my group is feeling that a lot today. One of the stocks that we invested in about the same time that we bought Aemetis just went up triple in the last 6 or 7 months. And it was based on the execution of their game plan. And it took time, but the whole Gartner hype cycle thing, people get impatient. I was just showing a chart that showed that the average US investor is invested in a stock for less than a year.
Mm.
And meanwhile, the private equity guys and the institutional investors, their holding periods have increased from 5 to 7 years, and they're the ones that have all the money. So, I try to get it across to folks, hey, I made my first million in a company called Exact Sciences, and I didn't make any money on it for 6 years. I just kept accumulating and selling cash secured puts and accumulating, and then it hit a hockey stick. So tell us about the hockey stick that's coming for Aemetis, or at least the ramp up and everything that you're seeing that I think that the hype cycle doesn't recognize at the moment.
Well, let's look at things that are external to the company that we know absolutely will happen. Because if you know something will absolutely happen, you can be very, very patient because you know it will happen. And when it happens, you predictably can make a lot of money. Let's start with a big one. The next 20 years of mandated low carbon fuel standard credits in the state of California, which means that all of the fuels sold in California, gasoline, diesel, jet fuel, all of them by law will have to have increasingly decarbonized, in other words, renewable percentages in them. And over the course of that time period, California has already stated they basically intend us to not sell any diesel in the entire state of California. So you have to completely replace the entire 4 billion gallon diesel market. That's a $20 billion opportunity that is growing rapidly. I can tell you that right now. But look at every one of those markets in California, and you look at the next 20 years, and then you can look at a schedule of decarbonization that will be law. And we have a history of more than a decade of the effectiveness of this program, because interestingly enough, it's not a tax. There's no federal government cash going into this thing or state government cash. This is basically telling the oil companies a very simple investment decision. Either invest in sustainable aviation fuel or buy the credits generated by sustainable aviation fuel. Either invest in ethanol or buy the credits generated by ethanol. Either invest in renewable diesel or buy the credits. Invest in things that decarbonize your fuel or just buy the credits. It's a very simple thing. You don't have to make any investments at all. Just buy the credits and deliver them to the state of California. No big deal. Well, as you can imagine, as those mandates get stricter and stricter, the price of the credits gets higher. I'll give you an example. The federal level, last June, the EPA determined that we should have a certain mandate for the D3 cellulosic renewable identification number. That went up from $2 to $3.50 within a matter of about a month. That is a 70+% increase in the price of that credit when people had clarity over a 3-year span that the EPA set out for that particular molecule, knowing that there were going to have to be every major oil company and minor oil company, minor independents, would have to buy more of those credits, and the supply would have to be brought on by guys like Aemetis, who saw this 5 years ago. And so our biogas business generated 75% more revenue within a month after that had happened than we did prior to that happening. That is about to happen. It was slated for March 21st, literally this week, to have the board of directors meeting of the California Resources Board to adopt the next 20 years of mandates. Because there was such amount of pushback on them saying, hey, your mandates aren't strict enough, that industry is actually moving faster than you're thinking, they postponed that. They're going to have a public webinar in April to kind of propose some new things, and then they'll have another board meeting probably in June or July. but the whole adoption wasn't going to be until January next year anyway. So it's not much of a surprise for the insiders that the board wants to get it right, because it is 20 years of mandates. And they put in a mechanism that Aemetis actually proposed 2 years ago, the automatic adjustment mechanism. That automatic adjustment mechanism says, if we're actually doing better than they expected all the way back there in 2024, and by 2026 or 2027, we're beating the numbers, then they should actually just go to the next year and decarbonize even more. That is in the final proposal. So we are in a automatically adjusting market that will mean that we will always need to have more decarbonization, which is exactly what they want, and cause a flow of cash into things that decarbonize. Electric vehicles and hydrogen are definitely on the list. But I think we're all learning. I believe the industry felt this for the last 3 or 4 years, but the market is finally figuring out the electric vehicles have some real serious constraints, financial constraints, supply chain constraints, sustainability constraints, cobalt with children in West Africa isn't too sustainable, et cetera. And it loses a tremendous amount of money. Ford lost $4.5 billion in their electric vehicle business last year. And the fourth quarter of 2023 was the first time since 2012, when Tesla launched the Model S, the first time that electric vehicles actually did not grow. There's a 10% reduction in electric vehicle sales. So if you're in California and you're saying, I'm going to decarbonize, a lot of the hype was, well, we're just all going to be running electric vehicles. Electric vehicle chargers are going to magically appear. And oh, by the way, the power lines to get electricity to the chargers are going to magically get permitted and built. And oh, by the way, the new production of low carbon electricity, not coal and not petroleum natural gas, but solar and wind, is going to magically sprout out of the ground. And oh, by the way, since those only work certain times a day, the massive batteries to store all that electricity, to run all these electric vehicles and our regular economy are going to magically sprout up. And it's all going to happen in a very short period of time. So who needs liquid fuels that are cheap, renewable, domestic, storable, transportable, and run on all the vehicles that are currently on the road, which are currently over 34 million in California, 34 million vehicles. And you can imagine that we made it a financial bet that the market is wrong, that electric vehicle adoption and hydrogen vehicle adoptions, hydrogen vehicles, by the way, are projected to replace more than 50% of the trucks in California in the next 5 years. We just bet that they were wrong, and we happen to be right. So investors make all your money when you bet that the market is wrong and you think something's different is going to happen. You're not going to make any money if you're doing exactly what everybody else has already done. You're going to buy at the top of the stock and end up selling at the bottom. You only make money when you think about the future in your own way, you draw your own conclusions, and you make your own investments. This is Warren Buffett's view, which is, well, if you like the stock at 10, you'd love it at 3. And so I see this as a wonderful opportunity. This is the March 2009 for the renewable fuels business. Now, one of the reasons I'm enthusiastic about it is when you start looking at each company, you find that there's very few companies. How many publicly traded sustainable aviation fuel companies are there? Well, the biggest one in North America, Montana Renewables, privately held by an oil company.
Right.
Just a little subsidiary of an oil company. You're buying an oil company when you do that. Down in Southern California, the second largest business, they're putting in $2 billion. World Energy is private. You can't even buy the stock of that company. Global Clean Energy, they don't even have an operating facility yet. They just got sort of taken over by Exxon. You can't even buy that stock. It's not a real publicly traded entity. So you start looking around, they go, okay, sustainable aviation fuel. I really want to make the play. You know who you have to buy? An oil company called Shell Oil Company has a plant in Rotterdam that's opening up later this year. You have to buy Shell Oil Company stock to invest in SAF. And then another oil company called Neste, that's an oil refiner out of Finland, who went to Singapore and built a big plant 20 years ago. You have to buy Neste stock. Those are the 2 stocks you get to buy in the world if you want to participate in SAF. Oh, did I mention there's also a little company that just got a permit in California to build the 3rd largest SAF production facility in North America?
Little company, right?
Is AMTX.
I give you a chance to breathe here. So a large part of my thesis, and it comes from a 4-step process that I stole from some giant investors that have become really big deals, Renaissance type companies. I stole their process, and I don't have their computing power, but I have always looked at the big secular trends, where the government support is, then the fundamentals of companies, whether they're good or improving, and then the technical analysis. And I was a quant before being a quant was a cool thing. And it's remarkable to me that indexing has destroyed small cap investing to the extent that it has. And just because, I've had some guys that are Elliott Wave guys pound their ideas into my head. And, I was a fourth turning guy 20 years ago, reading the fourth turning about generational cycles. It is pretty clear to me that behavior among investors changes gradually and slowly until there's a tidal wave. Right now, we're in the tidal wave of index investing. But as the boomers mature and starting to retire, right? The oldest boomers are 70-ish now, and the last baby boomer will be on Medicare and Social Security in 4 or 5 years. The pension funds are the only net seller in the market. What do they own? They own large caps. So there's going to be pressure on large caps starting imminently, and really already has. But because we printed $1 zillion during COVID, there's all this excess liquidity still coming in. Well, with the tightening from the Fed, that has made it a little tougher on small companies and companies that are getting started, and really kind of just, I think, pushed a lot of timeframes out a year or two. And now we have the Fed that's running into a situation with the treasury market and the banking system, and they have to cut. And they have to stop with the quantitative tightening. Whether it's this month or next month or in 3 months.
Yeah, it absolutely is going to happen.
Who cares? It's going to happen.
Yeah.
So that means that we're going to get a looser financial system. And historically, every single time that happens, Tom Lee is talking about this, and all sorts of other big shot investors are talking about this. Hey, the market might move before or after by 3 or 6 months. Who knows? I mean, long and variable legs, right? But every time these cycles play out, small caps go through the roof. Yeah. And I think there's a huge opportunity here in small caps in general, micro caps in particular, especially micro caps that have to get onto the Russell 2000. And, I take a look at your stock, and I said this about Spire Global back when I interviewed their CEO in August, I think it was, and everybody laughed at me. Well, the stock has tripled. And your stock had the short squeeze last summer, and now because your retail investors, who are the money at the margin, aren't buying small cap stocks right now, there's a problem for small cap stocks. However, in the loosening cycle, the big money will pour into small cap stocks, and then behavior changes a year later among retail because they go, oh, look, that one's up 300%. I guess I'll buy it now, right? It's like
and our stock, you've seen that cycle, Kurt.
You 3 times.
Yeah. And what's great about our company is we're institutionally managed already. Mm-hmm. Our board of directors is former Secretary of the U.S. Department of Agriculture for 5 years, Jack Block. He's on our board of directors. Right. The 2 Chevron people I mentioned to you included in the former Secretary of Chevron. A guy who ran 5 different public companies with $1 billion more of revenue, chairman of our audit committee, and a fellow that was on the Public Utilities Commission of California. That guy is on our board of directors. He literally was on the commission. If you did a little work, you'd find out that Leanne Randolph, currently the head of California Resources Board, was on the board of CPUC at the same time as my board member.
Right.
That's not a coincidence, right? Think about it.
Wait a second. You actually look at the resumes of the people you hire?
What is astonishing concept. Most investors don't start with, who's actually running this company? Who's on the board? I'm the chairman, obviously, but right. who's on it? And oh, by the way, how long they've been on it. The USDA secretary has been on for 17 years. You look at our senior management team, average tenure, 15 years. So when I bet on a company, I'm betting on the company. I'm not betting on a stock. The stock has to fit the parameters you described, which is are we in the right cycle of the trend? And we are. We just know that.
Right.
The question now is, okay, am I going to go to all 3 barbers in town, as Warren Buffett loves to say? No, you go to the best barber. So you look among the stocks you can buy for SAF, the ones you can buy for biogas, which is the second most exciting thing we're doing right now is biogas, and just read a bunch of stock analysts, and everybody's very, very excited about the 45Z production tax credit that starts in about 9 months. And the big winner there is biogas.
Right.
The D3 RIN, which is federal, 97% of it's made from biogas. It's the most valuable federal credit. The big winner in the low carbon fuel standard, biogas, negative 370 carbon intensity. The most credits you're going to make on any volume of fuel is dairy biogas. So you want to put those three things together and say, what stock will give me the opportunity to win when all three of these things come together? The answer is very simple. It's Aemetis. We're the only one that's that's a public company doing dairy biogas as our only product. We don't do any of the landfill gas, which is much, it's 1/10 as much carbon reduction in landfill gas. So I like your approach, which is let's understand the overall dynamics of the market. Well, right now, let's find out what's on discount and let's buy it. Because, within a couple of months, you got low carbon fuel standard that kicks in, and every institutional buyer is going to be in looking for what is the big winner on LCFS. 100% of our products in California generate LCFS credits. That cannot be said by anybody who's not in California. So you start looking around and find out, geez, Aemetis is the only public company in California. It doesn't take an institutional guy more than about 2 seconds to hit the buy key on AMTX. And you don't have to have many of those guys. Our biggest shareholders at times are BlackRock and AllianceBernstein. These are trillion-dollar companies. It doesn't take much of a button pushing. They just want to see the policy in place. So when do you buy the stock? Do you buy it 3 months after the policy's been in place, or do you buy it 3 months before? Well, you and I would buy it 3 months before. Most retail investors would buy it 3 months after and pay $15 or $20 or $25 a share for it. That's actually just because they don't do the extra work to say, which stock is really going to win? And that's an easy one. There's no other stock to look at. Nobody else sells into low carbon fuel standards. So if you know that that's going to happen, you know that we're going to be the winner, then institutions are going to buy the stock. So we'll have this conversation, 5-6 months from now and say, yeah, told you so.
Right. Yeah, we first bought Aemetis, I think it was just about exactly 2 years ago. And it was just a starter position. We didn't buy much. And then the stock spiked, so we sold like 3/4 of it. And then it came back.
Quite a gain, probably.
Oh, yeah. We made good money. And then it just started going down because I could see on Fintel and on my platforms, on interactive brokers, that the float was getting absorbed by shorts. And it goes through a cycle where they don't have fails to deliver. And right now they don't. Yep. And then all of a sudden the fails to deliver spike. And that's clearly coming. It's exactly what happened last year and a couple of years ago. So this is a stock that, I've explained this dynamic and people don't always believe me, but I know this is how it happens because I get invited in. There are trading rooms around the internet. They used to be Reddit guys. Now they are Discord guys, and ideas get fed to them through little hedge funds. The kind of thing that I could start with $30 or $50 million and little hedge funds. And these guys, they don't care how they make the money. They're not very scrupulous, and they short the shit out of stocks. And they find little itty bitty stocks that if they drop the idea to a trading room, get them hyped up to follow their trade, then it happens. Well, I was just looking at Fintel, and a couple of little hedge funds just closed their short position, which means that the short trade is almost over because they're starting to let the retail guys hang out to dry. So that means that as soon as the next money manager comes in, they're just going to get blown up. And then, my estimate of the value of the company today is between $1 billion and $2 billion. It's hard to know how things get valued in India and whatnot, but the intrinsic value of the company should be between $1 billion and $2 billion today before SAF is built. And the next 67 dairy digesters
come online. Exactly.
So
before India announces its expansion, which very sad is happening, that almost doubles revenue in India, and it's currently a $150 million contract we're working under.
Right. So let's talk about India. We got a bunch of questions. So India has expanded. They got a bigger contract. There's still excess capacity at the plant. I thought I read that some of that excess capacity is getting utilized some other way. So what's kind of the ramp here with India over the next year or two? And then obviously we want to know, is there a way to monetize that's in somewhat tax efficient way?
Absolutely. The nameplate capacity of a plant is the operating capacity of the plant. Okay. The regulator of revenues in India is the size of the contracts from the 3 oil refining companies. They're called oil marketing companies, but they're the 3 companies that own oil refineries in India that are owned by the government. They ship about 70% of the diesel in the country. Only about 30% is Reliance and the Russians, outfit called Rosneft. So the market is really the India government oil refining companies. They're our customers because they own the terminals you blend your fuel at. And they went for 15 years saying, okay, well, here's the price of diesel and we'll pay you a little bit less, or, oh, that didn't work. We'll pay you a little bit more. Well, that didn't work because the price of diesel goes up and down. It has nothing at all to do with the feedstock costs of making biodiesel. So about 2 years ago, they passed the 2022 National Biofuels Policy. And in it, they said, we're going to assure that we can buy the fuels that we have in this policy by changing to a cost plus model. Sometimes the feedstocks you make to make biodiesel are actually cheaper than the crude oil feedstock they used to make petroleum. Other times they're more expensive. But by correlating the pricing with the price of our feedstock, not with the price of crude oil, now they could have everybody operate, and every month you make money. There are some trailing 3-month calculations and some other complexities and things that means you better be a smarter trader than some of the other guys. But the bottom line is that over a year's time frame, feedstocks go up, they go down, but you make money when they're up and when they're down. It's just on a trailing pricing formula. So the $150 million calculation we have now, the allocation, we call it, is actually an increase from the $40 million allocation we had previously. So in a 12-month period, we have a $150 million allocation. The next allocation will represent the fact that we have increased the capacity of the plant. So we want to increase the capacity ahead of going and bidding. Obviously, it's not going to work to bid on something that is more than your capacity and then hope you can get it all built in a matter of a few days or something. So you have to build a bigger facility, which is basically an expansion that we've already completed, and we're going to do it another one here. And then you can bid on the bigger parts of the contract. Now, interestingly enough, think of it as not as one contract, but every single little distribution facility in the entire country being a place that needs to blend. So you're talking about literally thousands of locations that need your fuel. And the big oil marketing companies say, okay, I need this amount. And oh, by the way, here's all the places I need it to go. So they're just the momentum to say, here's the pricing. Now go out to all these places and physically deliver the product. So the India market is a very exciting market for a couple of reasons investors don't think about. If they read the National Biofuels Policy, they would see that there isn't, they've made it illegal to import biodiesel. So you see this increasing demand, cost plus pricing, but you can't supply it unless you build a plant in India. That's interesting.
Right.
So that means you don't have other competitors. You basically own the market. Well, we're the biggest producer of biodiesel in the entire country. We've been there 17 years. I went there and built our first plant there after doing 4 plants with Pacific Ethanol. We raised money, $720 million, and eventually built 4 plants of Pacific Ethanol in California and in the Western U.S. So our exposure was to the federal government and to the state government of California. And I decided I want something that was a counterbalance to that. And I was committed enough to say, what economy absolutely is dependent on biofuels? It's India. They have no domestic petroleum at all. They have to import it all. And it's over 1 billion people. We all know that. They're English speaking, by the way. So we have an opportunity then to say, okay, well, if we go over there, we could become the biggest supplier of what we know they absolutely have to do, because every year they have to export dollars to bring in crude oil, which makes the country poorer every year. They're going to be dependent on growing a domestic biofuels business. And we were exactly right. It just took a while, but we were right. And now we're the biggest, and we have what I would almost say is guaranteed profitability and guaranteed growth. There's 1 billion gallons short. It's 5% blend, it's 1.25 billion gallons. The whole capacity of the country is only about 250 million gallons. So it's 1 billion gallons of capacity. That's $5 billion of revenue for whoever wants to have it. We're the biggest in the whole country. So we are right now staffing our executive team. We've got some commitments from a tremendous, exciting guy that will be expected to join the company. And we're going to take the company public. The Sensex has been just a great run. If you look at the chart of Sensex, it is not China. It is not Russia. It's not Europe. It's not the U.S., who both have inflation problems. China has lots of different problems, and Russia's in a couple of wars. So it's the only major economy you can actually put money in as an institutional investor. And then you look at it and you say, my gosh, this country has to build tremendous infrastructure, including the non-domestic renewable fuels industry. And so it's very attractive to private equity funds and large sector players, and anybody who can find a pin, they want to be in India. And so we see a very hot stock market there, and we are planning to take advantage of that. And we have a very high expectation of the valuation we're going to get out of that. We've gone through this process once before. It was 2014. The Saudis and the Iranians ended up in an oil price war starting in the middle of 2014, lasted until January 2016, and that caused us to not go forward on an IPO in India. But we got a valuation indication of what our plant and our business model will be worth, and it's in the $1 billion range. So it's an opportunity for us to go back and say, oh, by the way, we delivered on all these potentials we had then. We just had a smaller plant then, but it had the potential to grow. We delivered on it. We've got the cost plus. We have no debt. India is completely free of any long-term debt. None. Zero. Zippo. No bank loans at all. And so we're debt-free, contracted, cost plus, growing, et cetera. And then I threw one little element in there that is unique to Aemetis. Everybody knows that we're not going to have electric airplanes, hydrogen airplanes, nuclear-powered small modular reactor SMR airplanes anytime soon.
Right.
So, by the way, Rolls-Royce sold their electric and hydrogen engine business, and their CEO was quoted, for at least the next 20 or 30 years, we're going to be using sustainable aviation fuel to decarbonize aviation. I don't want to spend any money on these things that we're never going to use for the next couple decades.
Right.
That's the CEO of Rolls-Royce quoted 2 months ago.
We both know a big investor in Rolls-Royce.
Exactly right.
Somebody just posted in our chat. It looks like it might be a hedge fund guy. I don't know who this is, but he just whipped out some calculations. He goes, the India plant's worth $1 billion.
Well, he happens to be in the target range. And one of the reasons I am confident that there's that valuation there is that our parent company has spent much of the last 2 years signing $3.8 billion worth of contracts with 10 global airlines, $1 billion with Delta, $1 billion with American, $370 million with Japan Airlines, $200 million with Qantas out of Australia. Right. So these global airlines all are exposed to the European penalties. So if you fly from San Francisco to Europe and you don't show up with sustainable aviation fuel in your tank, you end up with these penalties. And they're not like the friendly Americans who give you incentives if you do it. This is just, oh, you didn't do that? Well, here's a cash penalty. And so they're starting to charge on the tickets in Europe a carbon tax, a renewable fuels tax. They're capturing the money from their customer directly related to the SAF, but they don't physically have the SAF. So they're just facing these massive penalties. So we have in India the exact same feedstock, the exact same inbound feedstock tanks, the exact same boilers, and all the other outside boundary line fixtures. All you are doing in India that make biodiesel is called transesterification. If you just put a hydro treatment unit there and hydrogen treatment of the feedstock, you end up with sustainable aviation fuel and renewable diesel. Right. Everything on the outbound, tanks, trucks, it's all exactly the same as biodiesel.
Do people in India travel?
India can go to California and supply $3.8 billion worth of contracts.
I was making...
You start thinking, wow. Yeah, you're doing SAF IPO in India with existing signed contracts for $3.8 billion, and in the highest cost fuel, the only place with low carbon fuel standard credits is California, with 45. With the D4 RIN. That's California. You don't get that in Oregon. You don't get it in Nevada. You don't get it in New York. Anywhere else, you got to be in California. There's only 2 real airports in California: Los Angeles and San Francisco. Right. All of our contracts are San Francisco. It will literally go to the same tank that we deliver out of our California facility.
Right. As a baseball fan, I don't want to say anything bad about Oakland because I know they have some angst there, but I've been in the Oakland airport and I've been in the San Francisco airport, and you can sleep and you could live in the San Francisco airport.
Yes, you can.
Oakland airport, not so much. So mechanically, how does an IPO work? And do you expect to IPO just a slice of the company, and then keep the rest of the shares, or how does that work?
An IPO is, for us, just a fundraising. We're not giving away control. And frankly, if you sell common stock, they don't even have a board seat, right? It's like somebody coming in and just giving you a bunch of money for a small slice of the company. And obviously our goal is a smaller slice of the company. I would project something, most optimistically would be a 10% sale of the company. Least optimistically would be 25%. But in any case, we own 75 to 90% of the subsidiary. We have a whole bunch of cash sitting there on our balance sheet. And so when people look at the AMTX stock and they pop it up on Yahoo, they'll say, oh my gosh, they're sitting on $200 million of cash. Why am I worried about them only having a couple $100 million worth of debt? They've got $200 million of cash. They can pay out the debt tomorrow if they wanted to. The optics of the parent company dramatically change when we take a small little slice of one little subsidiary, put the cash on the balance sheet of that subsidiary. So that's probably the primary benefit that most public stock guys are going to have, is that nobody's going to come in and say, oh, that company's all in trouble. Eric's classmate from Harvard, who's been funding the company for 15 years through goods and bads and putting up new money, is somehow a scary guy, even though they put out press releases bragging about how great their investment has been. And how they've returned multiple times their investment already. They're supposedly harmful to the company. Well, if you're sitting on a couple $100 million cash, those arguments kind of go away. The second benefit is this, and it's something that most of the institutional investors pay attention to. Okay, wait a minute. You just went public. A public offering is not a sale of the company. It's just a financing of the company. What are you going to do in a secondary offering? Because the average IPO, and I don't know what span of time it was, this was in the Economic Times of India. Average IPO went up 40%. Okay, good. So we start out at some valuation, it goes up 40%. You know what the big popular thing is in India? Secondary market sales. So if we sell 10% of the company upon a primary market, sell another 10% on a secondary, that secondary theoretically is going to be 40 or 50% higher. And here's why. And this is stuff people are not expected to know, and I don't hold it against them that they don't. India's very interested in protecting the retail investor, but also giving them opportunity. So 75% of your offering has to be bought by institutions. Interesting enough, by law, 25% of the offering has to be offered to every single retail investor in the entire country. One of our customers went public, a little trucking company, VRL, if you want to look it up. At their IPO, they wanted to raise $100 million. They had $8 billion of orders, 80 times more than what they were raising, because every single person in the entire country by law can bid for the IPO stock. So what happens? Everybody knows this. You've got 80 times more. You start trading, and immediately institutions can turn around and sell to retail. Retail takes the stock up 50%. It was built by promoters. So think about it. Tata, Alana, the guys that are running the oil refineries, they built this system that is very quick to execute on. You don't actually have the whole SEC review process. The investment banker is the one that decides who gets to go public, not the Securities Exchange Commission.
Oh, I didn't know that.
Yeah, you can go public in 3 months, and because your investment banking firm looks at your audited financials, says, yes, you've listened to me, you got rid of your debt, you got cost plus financing, you're in a big growth market, I like your company, let's go. And they file, we are going public. Here's the document. They don't go to the SEC and say, hi, would you please review our documents and give me edits, and I'll go respond to the edits, and then I'll re-audit, whatever. No, it is you file, this is what I just did. It's built by the promoters. I mean, it doesn't take much for a $60 billion guy to get whatever kind of securities exchange IPO structure he wants that would give him a tremendous amount of upside. And that's exactly what India is. That's why I'm going public in India. So I saw this 15 years ago when I went over there. I looked around and said, oh my gosh, I built something in a value here, and I could really be in the same spot as a Mr. Tata, and he built the system. So whether we execute in a month, 10 months, or 2 years, the opportunity is exactly the same. And the liquidity benefit for us in the secondary sale is even more than the primary. So we're essentially sitting on a big chunk of cash over there that we get to monetize into growing the India business and growing our tallow export business, tallow export out of India.
I asked you a year ago about India.
Yeah.
Because I looked at it and I was valuing the plant. And I was like, okay, so if somebody wanted to start from scratch right now, and I didn't even look at the time frame that it would take, and I was just looking at dollars. And I was like, this thing's got to be worth $500 million at least. And then I looked at the market, and I was like, it's worth more.
Yeah, let me tell you what the real barriers are to India, and it's not a secret. You just have to be in India to know this. Unions are very strong in India. So we built the plant, and literally for the next 5 years, the local trucking company union would come in and say, we want you to only use these trucks, and we want you to pay these extra fees. And we said, no. Well, interestingly enough, that ended up being a tough thing to say. The president of the union twice had been indicted for murder.
What?
This is India. This is India. It's India.
Come on, man.
At midnight on the day of us settling our arrangement with him, the guy said, "You have to come to my house." And we sent a poor manager of our plant. We felt sorry for the guy to go to the guy's house at midnight,
Oh,
come to the terms of what has worked wonderfully for us for the last 8 years. But you can imagine how much it took for us to say, for literally 5 years, "I'm sorry, I'd rather not ship that product on time. I'm not going to allow that extortion scheme to work for us."
right.
It was a bribery scheme. We said, no, we're not going to do it. So it takes that amount of time in India for people to say, you can make money with Aemetis, but you have to do it legally. They will negotiate contracts. They'll post it on the official documents. They will pay you exactly what they agree to pay. They are that kind of company. Until you're proven that way, they will basically just shut you down. They'll shut you down directly and indirectly. They'll put 200 people in front of your gate and block the trucks. It is that's actually the impairment in India. That's why you don't see any foreign investor other than Aemetis. There's nobody else in the biodiesel business other than Aemetis in India. All the other ones are owned by local companies.
Right.
So it is a very unique situation. And it took, 17 years ago for me to build a management team over there. It took me 3 different CEOs before I got to one who actually had global professional ethics levels. I had to remove 2 different guys over time. It is not something that you can just wander in and say, well, I'll just learn all about how the British ran this place for 70 years and apply my American concepts. You've got to actually learn and build a team. So we're very excited. This is something I planned 17 years ago, and it's going to happen. We're gonna all feel good about it. It's just we're going to do it right. We're not gonna stumble along like some of these other guys.
Here, I'll let you get a drink of water here while I monologue. But so I have a few friends. Hard to believe. And one of them's a State Department guy. A couple of them are hedge fund guys, private equity guys, entrepreneurs, and a couple do import export with India, and then do other tech business in India. And there's the idea that India is deeply bureaucratic, and that is a barrier to entry, right? So when you take a look at a company and you're trying to figure out, do they have some sort of durable competitive advantage, right? Warren Buffett stuff. And I take a look at your company and I'm like, okay, they're working in India and California. They're years ahead of most competition. And then I take a look specifically of what could happen in India. And I think to myself, this could really be worth a ton 2, 3, 4, 5 years out, because as you said, and I'm a big EV guy, you know that. Mm-hmm. I always thought that the inflection point for EVs, way back when everybody thought it would be 2020, I was like, 26, 27, because of the way the laws, technology. And now that we've gotten through the early adopter phase of EVs, now it's to the point, well, for mass adoption to happen, sticker price has to come down to about the same as an ICE vehicle. And that's for sure not for 2 or 3 years, and probably not till the end of the decade. So if we're taking a look at, maybe the tax credits offset the difference in price 3 years from now, fine. But, you're really looking at 27 to 30 when EVs start to ramp up. But for heavy transportation, ain't going to work because of capacity issues and
aviation.
And it's not going to work for sure for aviation. And I actually think that heavy transportation, this was a topic at CES 2020, heavy transportation will eventually be hydrogen, but everybody who thinks that it's a 2, 3, 4, 5 year thing, no, it's a 2 or 3 decade thing. And you just can't pivot like that because there's hundreds of billions, there's trillions of dollars involved. You can't say, hey, you just put all that CapEx over there, you can't use it no more because we're going like that. So the Harry Potter magical wand of, everything's sustainable today. I love those movies, but and I want one of those wands that works. But, it's just the transition's going to take time. And the biofuels that are not, and your latest presentation makes a point of this, biofuels that are not food stock based, right? When you're using waste.
Waste.
Yeah. It makes so much sense.
Well, let's think about how our management team has future-proofed Aemetis. The first blushes you get when you hear renewable fuels is, okay, well, that's temporary. That's our transition. and then they're going to go away, and we're going to have magic electricity just kind of shows up. Okay, that's terrific. That's great, guys. I love that. Except for the reality that electricity actually physically comes somewhere. It's not an Amazon shipment or DoorDash just magically shows up at your door. No, there's a real restaurant involved. Somebody actually made electricity. Okay, so let's talk about carbon intensity of electricity. If you make it from coal, it's worse than driving a gasoline car. Okay, got it. We're not going to use coal. If you make it from petroleum natural gas, technically petroleum natural gas is positive 100 carbon intensity. Gasoline's about 92. So petroleum natural gas, though it burns cleaner, has a carbon intensity that's actually about equal to gasoline, slightly worse.
Right.
So that's why we don't have natural gas fired plants in California. We've had to go and restart them again. It's because the carbon intensity is worse than what they were trying to do with the grid. So, okay, got it. Solar and wind, that's going to be terrific. I'm a big fan of solar and wind. I founded SolarGen, $1.3 billion solar project, eventually funded with Consolidated Edison and Duke Energy. Bought 24,000 acres of land, did a 1,500-acre development. That's me. I was a founder of the company.
Right.
So I know the solar business, and I know the weaknesses of the solar business. First of all, intermittency. We have more solar energy in California than we can use at noon today. So you put more solar in California, you can't use it. You have to put batteries in place. And of course, increase CapEx and shift the electric load into the evening when people are running their air conditioners at home. So, okay, that's interesting. So how else can you make electricity, but make it actually negative carbon intensity? Dairy biogas.
Right.
CH4 is natural gas. It by law is pipeline quality natural gas. That's why we get to inject in the pipeline in California, Pacific Gas and Electric. But it's carbon negative, negative 370. It's not positive 100. It's more than 400 CI points lower than petroleum natural gas.
That's
so
that's a huge
drive your electric vehicle, you're going to need a bunch of dairy biogas, a lot of waste biogas.
Yeah, I don't think people wrap their heads around what a huge offset that is. Right?
They don't get the economics of it, but they're going to soon. They'll see 45Z. They'll see low carbon fuel standard credits go from $66 to $220, and they're going to say, I really wish when Kirk was talking about this back in March of 2024, he would have emphasized to me how much money is made when your feedstock is free. Remember, when you make renewable diesel, you have to buy something to make it, right? Make ethanol, you got to buy some cornstarch or sugar or whatever. Right. But feedstock for biogas is free. It bubbles up out of a pond of waste at a dairy. And then you share a little bit of the money with the dairy because the dairies are going to do fine. And you pay off your $400 million that you spend over 20 years. It is an unbelievable business. Free feedstock.
Yeah. I don't think people even are close to having their head wrapped around this. And I know there's going to be people watching this video because I'm announcing it on Wolf Financial on Twitter X tomorrow. And the SAF feedstocks are largely going to come from orchards and forest waste and other ag waste.
Waste oils, including our 50 million gallon plant in India, which is a waste from the animal feed business in India. People, by the way, don't realize India has the second largest populations of cows and water buffalo of any country in the world, but tallow from that animal can never get in the food supply. India is a Hindu country, and having animal oils in their oil supply is a religious problem. So exporting it for fuels is a tremendous solution, or just using it to make fuel in India. We have a natural hedge built in that we can use the tallow in India to make product, which is what we're doing right now physically. And we can also export it to California to supply our own plant or even other producers of renewable diesel or SAF.
Right. Yeah. And again, going back to that whole cycle, that all replaces oil or gas that would have had to come out of the ground. Yeah. So they were going to burn all this feedstock anyway, in most cases.
That's right.
Some of it gets, buried and composted, but it mainly gets burned. So that's all carbon going up into the air.
And air pollution.
Yeah. Right. So if you don't do it that way and you turn it into fuel instead, not only, and then you bury the carbon that you're not using, that's excess. Exactly. You're not only saving that carbon from getting into the air, but also it offsets oil and gas that would have had to come up too. So it's a double whammy. And I think my opinion is that, and it's going to take time, but as you mentioned earlier, Exxon's getting into it. Occidental's into it. Occidental's the other oil company I own. There's this company in Omaha that just won't let the share price go down, and I love that. So I get to invest in an oil company that's getting into everything,
Exactly.
and they have a patron. They have a financier that is in it for the long haul. Who else has a financier that's in it for the long haul? I don't know. I got to think about that. But
And by the way, has done tremendously well
yeah,
financially. Multiples of their original investor has proved to be specifically in our company correct. Bet on the right management team, the right market, doing the right plan, and has already cashed in multiples of their original investment already. And
right.
so investors, when they just read the balance sheet, don't understand the people. And I'm an entrepreneur, so everything is something you build in the future. You can't just say, well, give me the last 5 years, and as long as it's positive cash flow, I'll give you a loan. That's a commercial banker thinking.
Right.
Mine is, give me the team of people, show me the market, and then tell me about their strategy of how to get to that market. That's where I make all my investments. And some of them take some time. Okay, I'm comfortable with long time frames because I'm building things that are pretty large. Other companies, geez, I need 5 guys with a computer and I'm going to launch an app next week. Okay, fine, that's terrific. But I'm building stuff that requires hundreds of millions of dollars, $500 million to build, and will create billions of dollars of cash from their operation under cost plus contracts with large multinational organizations. That's our distinctive competence, is we can get that done. And you look at other people and you say, well, that team doesn't have the capability to do it, or that plan doesn't work. It's not financeable. So the hardest thing about Aemetis is we're doing really hard things. I actually read a book 15 years ago written by 2 younger guys, and it was the title of the book, Do Hard Things. And I thought, you know what? I'm at a point in my time in which I sold out of my first business when I was 33 years old, made a lot of money, and could have retired. I did another business, and by the age 37, made $120 million in that business. Could have retired. Did IPO of Pacific Ethanol, was 43, easily could have retired. This has been my retirement, is to take on the hard things.
Yeah.
And the investors that do well with us are the ones who want to take on hard things because they see the fruits of long-term cost plus contracts with airlines. You do that once, guess how many plants you can build? It's a 90 billion gallon global market, 4 billion in California alone. Every 100 million gallons you create is worth about $1 billion. This is the 4 billion gallon market. Every 100 million gallons is worth $1 billion. I can do this for another 10 years and build 5, 6, 7 of these plants. That's just SAF, and that's just cost plus. It's just our existing customers. It's that large of a market. So it's just a great time to be an investor. Largely confused market. Inflation is being beat, but requires still higher interest rates. So people are freaked out about the cost of money, and they don't understand how we spent much of the last 20 years developing a specific relationship so we can work through these times and come out the other end with 20-year financing with the USDA. I know you've seen this, but we've closed twice, 2 different loans in the last year or so. We've got another, $100 million in the process right now, all 20-year financing, all guaranteed by the U.S. taxpayer. So we are very pleased about that because that's low cost 20-year financing that we get to use to fund our business.
Yeah, I think people understand the renewable natural gas financing at this point. At least my people do. That's pretty easy. So the SAF, I know there are government loan guarantees to build those plants. How does that process work, and does it take forever? And are you already working on that? I presume. How is the financing going to work for the SAF then when that comes to pass? Because that's kind of on board for this year, correct?
It is. With the final set of permits, the authority to construct has been issued. Mm-hmm. And we are now basically going through there's a final engineering component so that you can go procure the assets. So as you can imagine with inflation, you don't want to have 2 years ago or a year ago price of construction because you're obviously going to be way off in whatever you do. So we're in that cycle right now. There are 2 elements. There's the senior debt, which we already have a signed and announced U.S. Department of Ag Biorefinery Assistance Program 9003 conditional commitment letter. So we've already went through a cycle with them at the Riverbank site. This project has evolved now to being really focused on SCF. So there'll be some amendments to that. But just like the loans we just finished, this is another loan with basically the same kind of conditions. You have to have your permits, you have to have a contractor to build it, et cetera. And so we're very familiar with the process. And on our board for is a guy who served as the secretary of the USDA for 5 years. So
Right.
we have as good a relationship as any bar was going to have with the USDA. I was in Washington, D.C. for 3 days last week and met with the administrator of the USDA and in the course of that, that person sat on the dais of the entire conference and cited Aemetis not once, but twice. One for our biogas, but the second was for SAF, citing how the loan programs of the USDA had been structured specifically to help companies, and Aemetis was using it to build the lowest carbon intensity biogas fuel product in the world, how Aemetis had just gotten all the permits to be able to build a sustainable aviation fuel plant. That was then followed up by, at the same conference, Tom Vilsack, the secretary of the USDA, standing up. And at the end of his comments, which are publicly disseminated, by the way, he said, I'm most excited about sustainable aviation fuel and how the USDA can directly support projects in making sustainable aviation fuel. So we're executing. The process will result in a financing with some equity in it. That equity is going to be structured in a way that we can buy the equity back over time, and then there'll be the senior secured debt in it. And so we have very strong interest from the airlines. They've all announced various initiatives, including a fund that was put together by airlines, and that fund actually closed about 60 days ago. And so there's a collaboration of airlines that have an equity fund to come into projects like ours, and then we buy them out. We pay them off out of cash flow and end up with 100% of the ownership being Aemetis. And essentially, it's two tranches, a senior debt and a junior debt or mezzanine tranche of financing for the project. Now, with a cost plus structure with customers, which we do not have, but has become quite popular to talk about, the airlines take the issue of whether feedstock is cheap or expensive. They take the issue of whether energy is high or low, and incentives, LCFS, RFS, IRA. In the scenario in which the incentives are continuing to do well and feedstocks are relatively cheap, which, by the way, is right now. Feedstocks are very inexpensive right now. The airlines actually get to buy the fuel below the price of petroleum. In exchange for us shifting that opportunity to airlines, they shift to us an ability to finance whatever we need to finance, because we're guaranteed to make money no matter what the cost of all of our inputs are and what the revenue incentives are. So we are in a very positive situation for SAF. What people lack is a site that is fully permitted to construct SAF. And by the way, if you're in California and you're delivering 90 miles away to the tank that supplies San Francisco airport, you're delivering into a fuel market that is probably $1 or more per gallon more expensive than anywhere else. So therefore, that's $1 more of subsidy essentially to the airline. They'd otherwise have to pay the expensive price of fuel here. And so it is exactly the market, certainly in North America, where you would want to ship SAF. And if you're 2,000 miles away, you've got a lot of cost of logistics to get it physically 2,000 miles away to here to get it to into an airplane. So you'd want a California project. That's why World Energy down in Los Angeles is a sustainable aviation fuel project, $2 billion being funded by private interests to make a small amount of sustainable aviation fuel, about 300 million gallons. There's 4 billion gallons required in California. So like most really large markets, it's not about competition. It's not, you could have 2 billion gallons of SAF flow into California, you'd still be 2 billion gallons short. This is about who's going to execute. It's not about competition, it's about execution. And what we find is it's very difficult to execute. So you have to go with the teams that have the experience and the capability and the vision and all the other stuff to be able to actually execute. And it doesn't matter how fast they execute, they're going to be the ones that get it done. So you bet on somebody else, they could be really fast and then blow up and you didn't get anything out of it. Your stock didn't do well. Right. You just need to go bet a management team and then go, go to sleep at night and sleep soundly, because you bet on a market that was right market, incentives are right incentives, and a management team that's executing. You just really don't have to worry about much, because you know these things are going to happen. And so that's what Aemetis was built around, was people that would think about these things that are actually going to happen, and Aemetis is a tool for them to participate in it.
So tell me if I'm thinking about this right. I'm pretty sure that I am, but might need some tweaking to my thought process. The airlines need to have SAF. All the rules are saying that they have to, all the regulations.
Yeah.
Delta owns a refinery on the East Coast. They've bought one. UAL and American have both been in that business before. I don't know if they are right now, but I know they're interested. And for them to be a JV partner in this sort of thing, if that's the route you go, the incentive for them is to get it off the ground. Hey, let's help this thing get started so that we have that fuel, because there's an advantage just in that. There's a cost savings just in that for them. And then if you buy the shares back, you buy the shares back, and you retire the debt. So their motivation isn't the same as my motivation directly, right? They're not trying to make necessarily an equity return on Aemetis like I am. They're trying to bring down their cost of fuel and not get penalized in the future because they're using so much fuel in San Francisco and LAX. So my supposition always was the airlines are going to help out. I knew they had a fund, and if not them, there's oil companies that would probably be involved, interested too, would be my guess. So, I don't see funding the SAF being the problem. In fact, I look at that. The only question I have about feasibility for Aemetis or anybody else in this field is carbon capture. And so, like, the companies that want to suck carbon out of the air, that's really hard. I don't think that technology is going to work, not in a cost-effective manner. But the way that you're doing carbon capture, which it's part of your chain, right? It's part of your cycle.
Part of the circular bioeconomy is we produce a lot of CO2 when we make SAF or biogas or ethanol or anything else.
So that's much easier to capture. It's part of the system already. You're just, instead of pumping it up in the air, you pipe it down into the ground, So, I keep doing valuations on this, and I just look at, okay, this is just what they're saying, and you open the can of worms on cross-examination here. So the judge is going to say I can ask this question. You said maybe more plants at some point. Tell me about that. How would that come to fruition?
Sure. We have sustainable aviation fuel is a global market, which is unique because it's 90 billion gallons a year. So our little itty bitty trickle of 78 million gallons in California is little more than 1% of just the California market, and 0.001% or something of the global market. It's nothing. Now, obviously, it's very financially rewarding. It's worth $1 billion to us, but the market is just vast. We're replacing the oil industry, guys. Come on, it's big numbers, right?
Right.
So at our specific site, we can do 3 phases of the same design. We can just do 2 and 3. And frankly, our existing customers will take all of it. I'll give you an example. Japan Airlines, we committed 5 million gallons to, if you read the press release.
Right.
They publicly announced that by the year 2030, a little over 5 years from now, they need 100 million gallons of SAF to be 10% of their global use. So they're our customer. We give them 5 million gallons. You can imagine I could be pretty comfortable allocating them for 5 million gallons for the next 2 plants, and it still is only 15 out of 100.
Right.
And you don't have to listen to them say, we want to buy 100 from whoever will supply it, and connect the dots to the fact that we're already signed up with them to know that we could sell them a whole lot more than 5 million gallons, right? So, and I didn't mention our biggest customers, right? American, Delta for $1 billion each. So there's an ability to do 2 more plants at the same site using the same infrastructure, the same management team, the same contractors, the same, just everything's the same. And it's just a matter of the process to do it. So that would be 240 million gallons of SAF. The $8 a gallon. You're talking about a $2 billion business, making 600 million a year. So it's pretty easy to see that that's what we ought to do, and we will still be 7% of the California market when we do that. Less than 7. We'll be about 6% of the California market. Not anything else. Going anywhere. Not going to Europe. We could ship all the stuff to Rotterdam. Probably make more money doing it. But just the California market alone, we'd only be 6%. And that's a $2 billion revenues company making 600+ million a year. So I'm comfortable SAF is a great plan. And carbon sequestration happens like 100 yards away. And we are the first and only approved characterization well for CO2 ever issued in the state of California. And so we're just putting the CO2 we produce. We already produce at our ethanol plant the largest amount of CO2 of any company, renewable CO2 of any company in California, 150,000 tons a year. We already capture it. We already cleaned it up. We already put it in trucks, and we already drive it. It's just we have to drive it 15 miles over to our carbon sequestration well, rather than off to some of the other companies that buy some of the stuff from us. So there's not, you just need a well on the ground. It's like my background in the oil industry. We're just sticking a hole in the ground, guys. Come on, it's not that hard.
Right.
And yeah, there's a lot of complicated things, but frankly, from a business perspective, pick the right place, pay the contractor, and you got yourself an oil production. If you pick the wrong place, you're not going to get oil production. But the process of just sticking a straw in the ground is not something that our contractors can't handle.
Right.
Baker Hughes was founded in the Central Valley, California in the 1920s. They now operate in 128 countries, have 20 billion of revenue, but they are a Central Valley company. They've been here for more than 100 years. Baker Hughes is our well drilling contractor. They put this on their list of risks as a very low risk drilling project.
Right.
They're just drilling a natural gas well and not expecting to find natural gas. That's what we're doing.
Right.
So I'm very comfortable that the issues are primarily political. Yeah. If you want to go to the California Air Resources Board homepage, look for the governor's letter dated August 2022, and you'll read what Governor Gavin Newsom instructed Leanne Randolph, the head of CARB, to do in this current rulemaking. He said, I want 100 million tons of CO2 sequestered by year 45. I want it some amount by 2035. I want you to increase the stringency on our emissions from gasoline, et cetera, by driving up low carbon fuel standard. It's written there and it's on their homepage.
Yeah.
Of what the government told. This is what the rulemaking is. It's coming up is implementing what the governor said. And so carbon sequestration is core to California's carbon emissions reductions.
Yeah, and I think you made the point that I was trying to get at was the part of the carbon capture sequestration technology that you're using is the proven doable stuff, right? It's not the sucking out of the air.
Yeah, we can absolutely take the CO2, which we already compress and already put into trucks, and just drive it over 15 miles away, offload it into the ground. You compress it as you put it in the ground. That there is no revolution involved with that at all. The hard part is that people that don't have the CO2 then have to look around and say, well, how do I get CO2? Oh, the CO2 pipeline. In California, remember, this is a guy who's done solar in California. Who do we get? It took 3 years to get permitted in solar. Not a problem. I set aside 22,500 acres permanently for the migrating kit fox and other stuff like that, and developed 1,500 acres, met all the requirements, got the permit. You know who sued me? The Audubon Society. They said birds will be flying over your solar panels and it'll reflect in their eyes. 5 years later, after resolving the environmentalists' lawsuits, we built the solar farm in California. So I think execution is where everybody wins. And the first and only thing we need to think about is what do we need to do at Aemetis to execute on these very local projects. And I think that we've shown we can. We've demonstrated over and over and over again that when people said, oh, you're just never going to get your California Environmental Quality Act. Well, we got that issued September 12th last year. How's that possible? Well, the lead agency is our local community. We picked the lead agency being the town of Riverbank, who benefits from all the jobs we create. And we work with them for years to get this project to go through all the hoops to be able to make it work. So I'm pleased to announce we have all the permits. There's no more question of whether we're going to get permits. We have all the permits to do our SCF project.
Right. Two more questions if you got time. One's easy. One is well, here we'll do the easy one first. Everybody wants to know, is Nevo ever going to come out of stealth mode? Is that technology still viable, I guess, is the question. Because it sounds interesting. Yeah. And I don't know how big it can be if it's just an add-on. But I think maybe people like the name, you know.
Yeah, so I like the name. New Electric Vehicle Optimization is what NEVO stands for. New electric vehicle means obviously we're moving toward hybridization. Optimization is that when you have a long-haul truck, putting a bunch of batteries in the cargo section means you can't carry as much cargo. So the battery electric vehicle long haul is just not really here. So the ability to use a hybridized engine and transmission mechanism is the obvious step forward on decarbonizing. So NEVO is based upon the need for the low carbon fuel standard credits to go up in amount, because when it goes up and you're not at $66, you're at $150 or $200 or $220, suddenly it becomes extremely economic to not use diesel in trucks, instead use a hybrid solution with electric drivetrain. Electric drivetrains have very low maintenance and are very, very efficient. They're 90% efficient at taking electricity and converting into motive power. And then you just put a little hybrid engine on that thing. You can run it with renewable diesel. You run it with renewable natural gas. So now you have a carbon negative fuel with a very efficient vehicle that doesn't weigh very much. And oh, by the way, the conversion doesn't cost very much either. And you look around and say, well, geez, there's going to be a lot of demand for that, because the carbon credits are going to drive up the compliance costs of running diesel, which is what the purpose is of the low carbon fuel standard. So you have to start thinking, well, what's after diesel? Well, renewable diesel. And how do you make renewable diesel as high mileage as possible? Use it as a generator, just as an onboard generator, so you never have to plug the truck in. This whole fantasy that we're going to literally invest hundreds of billions of dollars in new energy production facilities, new power lines, and new truck stops. Remember, you can have a truck stop that's all plugged up and everything, and guys sitting there for 6 or 8 hours wasting their time charging. But without a power line, you don't have any power for it. Now you're saying, how long does it take to permit a power line? Well, give me 20. And then, oh, by the way, without new production, we're already having brownouts in Texas and California. Without any new production, you can't power it. You have to have the entire infrastructure. You can't not say, oh, I've got electric power production, and we have all these wonderful plug-in places, but no power line. You have to have the entire value chain. NEVO is basically stating the obvious, which is you don't ever have to plug it in at all.
Right.
You just fuel it with renewable fuels, carbon negative 370 CI score, renewable natural gas, which Aemetis makes, and low carbon 100% renewable diesel, which Aemetis actually makes in India, and it will be the byproduct of our sustainable aviation fuel. That's the fuel for these trucks. What's missing is the trucks.
Right.
So NEVO is a very obvious solution to take our fuels to market. And that's why Aemetis owns slightly less than 20% of it. Is that it's an obvious expansion of access to market at very high margins when we are running our own technologies and getting people to buy our fuels.
Okay. I wrote about the hybridization of trucking and cars, but trucking in particular, because as a good Sicilian, I do have a relative that was the president of the Teamsters at one point. And
we need to call you guys.
Yeah, so I understand. Right. That's why I can make Italian jokes. But I understand logistics, and good friends in logistics too. And the hybridization of logistics is a ridiculously good idea. The whole Elon Musk, let's build these electric trucks. The problem is the space and the weight, but the space that the batteries take up, reducing the amount of cargo something can carry. It's just math. And so when you break it down, the math will generally take you to the right answer. Exactly. All right, last question. I don't want to keep you all day. I know you're a busy guy. This CARB meeting's coming up. They're going to set the rules. It all kicks in January 1st, 2025, I think. What's kind of the worst case scenario, best case scenario? And do you think they land in the middle, a little in one direction? I mean, I think I know the answer, but you're involved.
The good news is that in December of last year, they actually published the California Resources Board's staff comments, and then attached to that a couple of hundred pages of actual regulation that was proposed. The staff comments, about 40 pages, says this is what we want to do, and this is how we want to do it. You read that 40 pages, you very quickly conclude they want the price of these credits to go up so they can afford to have electric charging stations and hydrogen fueling stations and new hydrogen production and new hydrogen this, new electric this, new hydrogen this, new electric this. And then they actually conclude in that 40 pages, oh, by the way, this is not going to happen anytime soon. So the only way we're going to get there is to be able to have more of the low carbon biogas, biomethane. They literally say it over and over again. Biomethane can make hydrogen. That's CH4. The H4 is the hydrogen. So carbon negative hydrogen comes from what? Dairy biogas. So to make hydrogen trucking in the future, you need dairy biogas to do really well now. Oh, by the way, temporarily just run trucks on it. But as hydrogen trucks come in, then you actually are making hydrogen from the same thing that was running the renewable natural gas that is produced by the same company. So biomethane is a core part of the future of California forever. It's how we're going to make the electricity for the cars. It's how we're going to make the hydrogen for the trucks. And, oh, by the way, temporarily, being sometime in the next 30 years, as we're moving from diesel to renewable diesel trucks to renewable natural gas and eventually to hydrogen trucks, we need to have those fuels all do well, those renewable fuels all do well. So they are adding sustainable aviation fuel to the mix by making airlines obligated for the first time ever under the low carbon fuel standard. I was in the meeting with the Environmental Justice Advisory Committee where they adopted that then went to the board and is now in the staff proposal. There's no going back on that one. I don't see them seeing aviation as being a get out of jail free card. And yeah, you can fly in and out of California, and they mandate it in Europe and everywhere else, but not in California. I just don't see it. It's one of those obvious opportunities. So we'll see SAF and the low carbon fuel standard demand from aviation continue to expand in low carbon fuel standard. Let me make a very important point. How long would you take if you knew that something was going to happen in January next year and you could buy a credit now cheaper than what it's going to be worth next January? Would it take you 3 seconds or 2 seconds to start buying low carbon fuel standard credits?
Right.
The fact that it's getting adopted in, let's call it 9 months from now, is really irrelevant. As soon as people get confidence that the adoption's happening, they're out buying LCFS credits. If they believe that the CARB staff in that 40 pages is right, their demand for those credits is going to succeed supply for the next 20 years. On our 5-year plan, we put the slide up that is not our slide. It's from the California Air Resources Board, showing that in 2025, we hit $220. And there's a cap there, by the way. It's $200 plus the cost of living index from 2016. It's in our slide deck. Sure.
I think that the LCFS credit is suppressed right now for various market reasons and people waiting. But if they do what they said they're going to do.
That's right. That's exactly right.
I think the price moves to 220 way ahead of 2025. I think it happens. Well, I guess most people are thinking by the end of 2025. I think it would be closer to the start.
Yeah, I agree.
Because the way that those companies work that need the credits, they can't wait till the end of their cycle. They have to know. They have to have certainty, because otherwise they tell their shareholders, if they're public, we think we're going to do this, and then all of a sudden they have this big expense and they're like, ooh, we didn't plan for it. So demand goes up pretty quickly. I think it's a 3 or 4 quarter thing, not a 7 or 8 quarter thing.
By the way, we saw this happen between February 2019 and August 2020. It went from $65 to $218. So, and that was no big, massive new mandate. That wasn't 20 years of visibility or anything like that.
Right. And how fast was that? That was in
February 2019. They adopted the 5-year plan. By August 2020, it had gone from $65 in February 2019 to $218 in August of 2020.
So 6 quarters almost without a catalyst.
With no 20-year plan, this is absolutely going to be what it's going to be for a long time. It was right. This is just watching the same movie over again. Is all it is.
And then how does that impact Aemetis, so people understand why we're talking about it? Our
management team built the company so that all of our products sold in California get low carbon fuel standard credits and federal renewable fuel standard credits and Inflation Reduction Act production tax credits and Inflation Reduction Act investment tax credits.
Right.
4 different levels of revenue for a biogas business, revenue or investment tax credit reimbursement. And so we did it on purpose. Right. We're betting that California is actually committed to decarbonization. And I think we're right. And if you read the governor's letter, I was at an event with him. Our president just had lunch with him, and a small group of folks that are close to him. And our view is that California knows it's a prosperous economy. It knows it has sustainable economic advantage from its geographic position and its talent pool of colleges. And unfortunately, it's abusing that and saying, look, if you want to be in California, you're going to have higher costs. Your real estate's going to be more expensive. Your fuel's going to be, but look at the benefits you're going to get.
Right.
And the people that run this state are from one particular political party that believes that the really higher costs that go along with this are getting us a better environment and getting us a better place to live. And they're willing to pay that. So when you tell a California regulator or politician, oh my gosh, that's going to raise prices, their answer is, yeah, I hope so.
Right. They shrug their shoulders.
You're saying, yeah, that's great, because that means we're actually investing and you're not. We're actually doing something and you're not.
Right.
They seek to lead. And I think we need to bet on that. We need to say, yes, these people eventually figure out how they can become leaders in a cleaner and better world, which is what they seek to do.
Right. So, since I was a kid, my grandfather, who was a pound the table Sicilian guy, and my dad and my uncles, they all, and it didn't click with me until I heard it about the fifth time as a teenager. If it's happening in California, it eventually gets to the rest of the country.
Yeah, we're the bellwether state for almost all this. I agree.
So that means that not only is the opportunity in California huge, but let's suppose Nevada or Arizona adopts similar, or Oregon probably would adopt similar rules.
That's right.
I mean, those are more markets to sell into or expand into.
Yeah, actually, Oregon and Washington have already adopted their own versions of it, and we're spreading now to New York and Pennsylvania and other places. So it's really a national trend that will take, I don't know, a decade or so. But the concept that this market that doesn't require any taxpayer money is the way to evolve a cleaner fuel supply, which, by the way, includes improves air quality, reduces carbon emission. But for me personally, it supports the 2007 Energy Security and Independence Act. Energy security and independence, that's about military. That's about geopolitical economic power. That is the renewable fuel standard under which renewable fuels were adopted. The guy that signed that was President George Bush.
Yep.
So, a fellow who had the 2011 event on his watch sees this as a military independence issue and economics issue. And that's exactly why I'm involved with this. Yeah, okay. There's a lot of people that think it's all about the environment. There's a lot to be said about being energy independent from people who are funding who fund terrorism.
If people go online and you can dig this out, it's called the Quadrennial Report. And President Bush's administration talked about energy independence as being a fulcrum to just general security and prosperity. That's right. So, I mean, that's been, especially since 9/11. I mean, it was always a consideration, but especially since 9/11, it took off. People are like, oh my gosh, we can't be beholden to really anybody for our supply of necessary things, whether that's semiconductors or energy. And so everything's been shifting to balance. I mean, globalization is good for peace because everybody has a chicken in their pot. And that goes back to the Marshall Plan. But you can't be in a position where you can't do it yourself, right? So, all these things are having hundreds of billions of dollars allocated to them, again, from semiconductors to energy, and it can't stop. And it doesn't matter who gets elected president. I mean, can things get delayed a little bit or slowed down a little bit, right? It's like playing defense on Michael Jordan. You can't stop him. You can just hope to slow him down, right? So, all these things are coming. Time frames are a little fungible, but the expansion of what you're doing and what Occidental's getting into and what Chevron's getting into and everybody else is getting into, it's unstoppable. And in particular, it could speed up. It's more likely to speed up than slow down, because what if that guy in California becomes president someday?
Which, by the way, in the next few months, think about it.
Yeah.
That's a pretty high probability. That I wouldn't completely ignore that.
Yeah. Well, I don't know if I'll just tell you, because I'm sure you didn't read it. Maybe you did. I don't know. I'm a pretty good writer. But I said that maybe the Democrats don't run President Biden, and it would be a pretty interesting announcement if a week after the Republican convention, which is here in Milwaukee, if anybody wants to come, I'll show you around. If there's a different announcement from the Democrats that, hey, maybe we're going to have an open convention. Not saying it will happen. I'm just saying I think it's more than a 1% chance.
Yeah, and there's health issues that neither candidate control. But let me put it this way: even as governor of California, Gavin Newsom effectively is running the fourth largest country in the world.
Right.
So
right.
we have plenty of tools here. I think he has played his cards very, very well.
Yeah,
and would be well positioned to become president in November. It's certainly something that we shouldn't ignore. And so his policies will have impacts whether he's actually a candidate or not, as everybody's trying to put themselves in a good place so that if that happens, they aren't in the out crowd. You know how that goes.
Right.
So
Right.
you'll see a lot of policy activities of the federal government is really just copying California. The Inflation Reduction Act in many ways was a copy of low carbon fuel standard.
Yep.
So I think we're doing the right things. I apologize that regulators are slow at times, but I think we're going the right direction. We're doing the right projects, and our timing is actually very, very good. I think when we look back in 2024, you'll see it as this incredible release of value, not only in California, but also in India. And a lot of people say, gosh, I wish I had attended Kirk Spano's call there back in March of 2024 and thought about it and done something about it, because that's the time to buy, not after all the stuff had been executed.
Yeah. You know, I have a reputation for being 2 years early. So I hired a technical analyst to help me with that. And, you know, I got my first nibble on this company 2 years ago. We made the great trade last year. We haven't sold a share. At least I haven't sold a share. And, you know, but we made some option trades. And right now, I see this lining up for a much longer term rally, because you'll get the squeeze. Great. Your traders will be in and out. But the reality is that this is Gartner hype cycle stuff. And now we're to the point of heading into adoption. Yeah. And that's a pretty great curve to be on.
Yeah. And I do want to just depart by saying that Tom Vilsack just gave a speech in Washington, D.C. on Thursday. And in that speech at his end, he said, I am so excited about SAF. This is online, by the way. You can find it if you want the transcript. Okay. I'm so excited about SAF because it serves as an engine that can transform the agriculture economy, because we will not have electric, hydrogen, or otherwise flying airlines and airplanes. And the ag economy is the only way that we can actually take the waste products from things we already do and turn it into something that fuels aviation. It's a sustainable global growth market. I agree with him completely, but he's the guy that can sign our loan guarantee based on the White House 3 billion gallon per year grand challenge that I attended online with him September 9th of 2021, along with Pete Buttigieg and Jennifer Granholm and the head of the U.S. Department of the Defense Department, when they announced that grand challenge. And we just did that. We just permitted an SAF plant that he says he wants to support to get us where we're going to go. Don't bet against that team. The USDA, Aemetis, the head of the USDA serving on our board for 15 years. Don't bet against that team. That's a message for the short sellers. There's short-term games you can always play, but you do not want to be in a place in which we bring in a couple institutional guys because we just announced the cost plus deal with SAF and USDA has given us 20-year financing. You're going to be crushed. And I want people to be able to go back to March 2024 and say, well, Eric never told me I was going to get my head handed to me if I was short the stock. Well, I'm telling you right now, guys, do not bet against this team. It might take the last couple minutes of the football game for us to win, but we can be behind 28-3 and come out as a winner. And this is a message for people that need to hear. Just don't bet against this team. It's going to turn out badly for you.
Well, for people who understand stock charts, it's a triangle and it's about to break out. And I don't know what week it's going to break out, but it's coming. And I mean, these are the setups that if you're more short term, you look for the trade. But if you are an accumulator, like I finally figured out who HVB Capital is. Hi, Hugo. Then, you know, you get to accumulate all these shares. And then again, I showed a chart earlier that showed that the average American stock holds a stock for under a year, but the average private equity guy or institutional investor or family office owns stocks for 5 to 7 years. You can try to outtrade the machines in the system, and guys like me, who, again, I could also retire and just manage my own book, and I don't. But, you know, you take a look at who you're up against as a trader, and you say, okay, go ahead and do your best. I hired a guy who he's kind of all over the place when it comes to putting his ideas out there. Not a great writer, but he kills it as a trader. And I just watch him and I go, holy cripes, I wish I could do that. That's 1% of the people out there that can trade this market, maybe 2%. And it's because the machines are so powerful and the algos and everything else. So in small cap spaces where you can get essentially, if it was professionals doing it, we'd all go to jail. But it's, you know, it's guys in trading rooms and on Discord doing it, so they get away with it. And they get away with it until somebody with a bigger checkbook comes in.
Exactly. Yeah.
And me and Hugo, really, it was me and Hugo, with just who we touch as little guys, stabilize the stock. Exactly. What happens when GMO buys more? And honest to God, the fact that you have GMO on board is one of the things that got me looking, because I've been a Jeremy Grantham guy for 25 years. Yep. And, as institutions buy, that's it. I mean, there's only 40 million shares, give or take. So there's just not much float to buy.
That's right. That's exactly right.
So, all right, I'll let you go. Thank you so much for the time. I mean, I didn't anticipate an hour and a half. You're incredibly gracious. I will be in San Francisco area in October. I have a wedding in Arizona, and then we're going to go to wine country. And so hopefully I see you then and going to see some clients. And, I did my first tour of Silicon Valley when I was out there with you guys in May. And it gave me a whole new perspective, because I'm from factory country, factory and farms. And I didn't know what Silicon Valley was. I thought I knew, and then I saw it, and I was like, oh, I get it now. And they're building another, they're kind of building that sort of stuff in Ohio and Kentucky and, out east. I mean, definitely. I don't think people quite grasp in an era of negativism how positive not only things are going in the country, but where these big secular trends are going to take some of the small companies, because it's hard to move the needle on a big company, right? So you are, you're doing the same thing that Exxon, Chevron, and Occidental are doing. Yeah. But it's the law of small numbers, right? I mean, Exxon, Chevron, and Occidental might all double, but you're at 200 million market cap or whatever. That's a 10 bagger, just a 2 billion. Exactly. And I think that's just the RNG. Yeah. SAF, I think, you once told me that you thought that this could be an S&P 500 company, and the more I learn, the more I think that you're probably right about that. So
we're in the right market to do that.
Good luck. Give me more retirement money. All right. Thank you very much, everybody. Eric McAfee from Aemetis. And this is my largest small cap holding.
Thanks.
All right. Take care.
Talk to you soon.
Thank you.
Take care.